but mistakes do happen. So please make sure, because this is in a meeting format, not in a webinar format, that your mic is on mute at all times. Please raise your hand or post your question in the chat if you'd like to ask a question. So I can't be heard. Can you hear me? Okay, so it's not on. So Titania, I think the problem is on your side. So I'm not sure who can help. I think Amandine can maybe sort of navigate some of that stuff. You might need to play with the actual sound settings on your PC, which might actually be the problem, so not Zoom itself. So having said that, as I said, please, when you are going to talk, if you can turn on your video, would be nice. I know some people have got bandwidth issues, so we will respect that. Please, and as I said, the discipline of making sure that you join and turn your mic on mute is quite important. So I think from that perspective, it's about 3 minutes past. I think we're going to start. So basically, Amandine has actually, Bojan has actually posted the documents that are available for you in the chat. In terms of the program for the day, we basically are going to start in the same format that we've done for the last week, where we've got a presentation by Bojan, who actually covers the methodological guideline. And he actually goes into quite a bit of detail into that methodology. And as I said, today is the last of the trade misinvoicing presentations, where we're looking at the price filter method. We're then going to have our 30-minute break. And then we're going to go into the actual case study, where Luciana will be presenting from the Ministry of Finance in Brazil. They haven't joined us yet. They'll be joining us after the break, just because it's very early. And then following that, Pedro is actually going to go through some Python coding, as well as some Excel spreadsheets for you as we do the practical side of things. So with that, I'm going to hand over to Bojan to navigate us through the methodology on the price filter method. Thanks, Bojan. Over to you.
Thank you, Kathy. And good morning to everyone. It's very nice to see you after a weekend. I hope it was a relaxing weekend at your ends as well. So as Kathy has mentioned, so today we are looking essentially into the method, the second method of the trade misinvoicing. Okay, yeah. So this method is called the price filter method. For those of you who have been with us on Friday, so you may remember that we said, so that the method that we covered on Friday, which was on the partner country method, is sometimes best seen as a method to obtain an overall overview of what is actually going on in terms of the trading flows. So to identify potentially critical or riskier flows or partners, so trading partners as countries, or some commodities or commodity groups. In terms of the measurement itself of the illicit financial flows, the other method, so the price filter method, which we will be looking into today, is deemed as a more accurate or reliable measure for that. So that's why we, in addressing the trade misinvoicing in a particular country, we would advise to essentially use both of the methods in combination, having partner country method from Friday as a starting point, and then price filter method to look into a specific commodity groups or flows of partners to be more used for a actual measurement of tax and commercial illicit financial flows. So if we just start right away with the concept and the assumptions behind this method. So first of all, we have to list here that unlike partner country method, which was a top-down method, the price filter method is a bottom-up method, which means that we are looking and starting our analysis at a very granular disaggregated level at the transaction level, and then slowly building it up to a value of the indicator. It is important to identify that. So in the price filter method, what we're looking for is the presence of abnormal prices. So those are the prices that will tell us that something is not right in terms of what the price should be on the market. So this is essentially referred to as deviation from a so-called arm's length principle, or the arm's length prices. So the arm's length prices are the ones that are deemed correct, so to say, in terms of the market, which means any price that is deviating from this arm's length price, either above it or below it, is considered a abnormal price, and as such, a sign of misinvoicing or mispricing specifically in this application. Moreover, the price filter itself, it's not just one price, but it is presented as a range, as we will see later on. So we have a range of prices that are deemed normal, and any prices that fall outside of that range are considered as abnormal prices. Now, this range will be determined by various factors, but essentially they will, of course, reflect the specific circumstances to a particular commodity we're observing, but also to the economy, to the potentially political affairs, and so on. So the main advantage of the price filter method is that it is using transaction level national data, which means, first of all, that we are, as mentioned earlier, we are doing a bottom-up approach. So we are starting at a very disaggregated level of data. And second of all, we are using national data, so nationally acquired data. So there is no need to be looking for bilateral partners' data. You may remember in the method on Friday, so the partner country method, in order to obtain some results, we need partner countries' data. In this case, in the price filter method, this is not required. So we can only work on our data, on our nationally acquired data, which of course makes it more efficient and processing at a lower cost. And maybe just one thing to say here, I think there was a question on Friday, which Kathy also addressed. So when we use the price filter method, we can also detect cases where a collusion is happening. So when both, let's say, our exporter and our partner importer are colluding to produce the same invoices, either over invoiced or under invoiced, price filter method can also detect those cases. Now, of course, there are limitations to this method, obviously. So the first one and the major drawback of the price filter method is a so-called indigeneity of statistical price filter. So what is actually going on behind this? Every time when we use statistical price filters, we will find transactions with abnormal prices. So statistical price filter essentially means that they are using the available transactions that we have. So we are looking at the observed data of transactions of prices. And we define a price filter in a statistical manner, meaning that we are looking, for instance, at a interquartile range, which is the usual practice to be applied here. There are other ways, of course, but whenever we do this, we say, okay, so the lower few percentiles or the quartile and the upper one are deemed as abnormal prices, which means by definition, we will always find prices that are abnormal. So this indigeneity of statistical price filters is a major drawback of this method, and we will look into how, if there are options to remedy this limitation. The next limitation is associated with the heterogeneity of products. So even at a transaction level, so when we are using a very detailed level of a classification of products, for example, the HS, we will still find differences in actual commodities being traded, even though they fall within the same category at the, let's say, 6-digit HS level. So products of varying degree are included within one category. Now, of course, those products that are different would essentially have different prices. And using the price filter method, we could identify them as abnormal prices, even though they may in fact only reflect their true differences. So we could have, let's say, in the one of the commodities, let's say the mobile phones or whatever, it's mostly in the IT sector or the high valued commodities such as gold, for instance, so that they're all grouped into one category. So on one 6-digit level, HS. However, there are varying degrees of quality, and a higher quality, of course, would mean higher price, but the price filter method could pick them up, even though they will essentially just reflect the different quality of the products. And moving along, the price filter method is also unable to identify cases when legitimate unusual prices do happen. There are two major, let's say, groups of cases. One is the long-term contracts. So when we have a long-term contract, this would usually mean that the prices negotiated could be lower than what the actual, let's say, market prices would be. So in those cases, those prices would not, they may be picked up as unusual prices, as abnormal prices, but they should not have been because we have a long-term contract behind it. Another case is when we have volatile prices. So when we define the price filter, and for example, that we use an annual price filter, which means that we have one price filter, one price range for an entire year, but then this commodities prices are very volatile over this entire period. The market price is going up by 40–50%, may be reflecting the actual market situation and not be a result of overpricing of the products. So those things have to be inspected carefully when we move ahead with our analysis. And similarly, it happens when a I'm sorry, I think something is. Can you still hear me okay? Because I have some.
I can hear you clearly. I
Okay.
can still hear you. Yeah.
Okay. Perfect. Thanks. Apologies. So another case is when we are when the price filter is unable to detect abnormal prices when there is only a small difference in the price. So when the price is varying or being underpriced or overpriced by only a small margin, of course, the price filter will not pick it up. And moreover, we are also using the price filter method, not capturing any misrecording or of quantities and so on. So if you remember, we said that we are addressing the trade misinvoicing. However, with the price filter method, we are essentially looking only at the trade mispricing. So we are only observing what is going on with the prices. So we are not considering anything that is going on with the quantities. Of course, the issues that we have listed as limitations of the method can be, to a certain degree, overcome if we take a few steps to address them. So in the in the guidelines, there are a few enhancements proposed, similar to the partner country method, and those are, rendering the PFM plus next to it. So we have the plus, which is saying that, okay, don't just use the price filter method in its most basic form, but make sure that you apply certain steps in order to overcome the limitations of the method, and hence making it a more reliable statistical measurement of illicit financial flows. The first one is to set price filters at a detailed level. So ideally, we would be looking at a identification of price filters at the most detailed HS cost level where we have available. So this would be essentially identifying the market better, and therefore we will be able to identify the abnormal prices more efficiently. However, we have mentioned that even at the lowest level of product classification, those products can exhibit differing quality levels. So it is therefore important to supplement those lowest level of classification codes with a description of commodities. So those descriptions of commodities may actually help us to understand where, in fact, this product in question would be falling in terms of quality, and therefore also in terms of their prices. We mentioned earlier, for example, gold or IT products seem like a very natural candidates for such quality variations within a single product code. So in order to actually obtain those information or to apply this knowledge, we will actually need, as in all the methods so far that we have mentioned last week, we will have to apply a expertise or national trade or customs experts in order to properly account for those issues. Now, in some of the cases, this will of course depend on data availability. We may be able to refine or produce the analysis, also taking into account what our trading partners are. Now, please bear in mind that this, when we discuss the trading partners today, is different than when we discuss trading partners on Friday. In the partner country method, so the method from Friday, our trading partner was a country. So the analysis was done at the country level. Today, since we are conducting our analysis at a transaction level, our partners are essentially companies or entities we are trading with. We are either exporting to or importing from. And this is important because our trading partners, so those entities, those companies that we are trading with, could be located in different countries. So they could be in let's say, a tax haven countries or non-tax haven countries, which is a very important implication. We will see also later in the case study. Or they could be members of the same M&E group, so related units or not. So this is important to try and understand, but also distinguish between the trade mispricing, which is an illegal activity, or transfer pricing, which in itself falls under the category of aggressive tax avoidance. So transfer mispricing. So it is important to see whether we can obtain those information to identify who the trading partner for each transaction is. And if we can do that, then we can also separate or identify the breakdown of trade misinvoicing, so trade mispricing, or aggressive tax avoidance, or transfer mispricing. So this will be an important step when we move into the analysis. And in some cases, this, of course, can be done, and implications may, of course, be very relevant. The second way to overcome the limitations is to use a free market prices for the filter. You may remember we said that the major drawback of the method was that the statistical price filters suffer from indigeneity. So what are the alternatives? Well, to use the free market prices. Now, of course, to use the free market prices would mean that a certain commodity which we are observing or studying would need to have a free market price available. So this is the international, well-established market where the prices, of course, are also transparent and prices are actually obtainable. This is not usually the case, or this is not always the case, maybe. So therefore, sometimes it is not as simple to simply say, okay, we'll use the free market prices. Maybe they do not exist. If they do, however, we can use them and avoid indigeneity problems. If we can, if you cannot, however, use the free market prices, so which means that we are left with the observed prices within our transactions, we could, as an alternative, use a so-called moving average of those observed prices. So this may somewhat remedy the case of a statistical filters in terms of stability, which we will also see at a later stage. However, proposal is to use free market prices as much as possible. Last, but certainly not least, is a step to consult experts. So experts of international trade or of pricing would have to be brought into this game, but not only at the end. So even though this is here listed as a third bullet point, it should essentially be applied throughout the application of the method. So both from the start to observe which data are to be used, what do they mean? So both at the input side, but then also when we obtain results and when we provide interpretation of those results. So expertise knowledge is very important to be brought here to the table and to be applied in order to make this measure, so this method, as a reliable measure of illicit financial flows. And here it is also maybe important to note that it is, again, a collaboration of units within the country or within the national statistical system is a key to actual proper application and reliability of those methods. So it is not only the national statistical offices, but also, and foremost in this case, the customs offices and any other potential stakeholders at the national level to be used to help build the knowledge and properly identify abnormal prices to be essentially producing a reliable figure of the IFFs from trade misinvoicing. Okay, so now what data do we actually need? So this method is building on a transaction level data of international trade flows. So we are looking at the flows, the prices, quantities, values, products, trading partners as well. It is useful, of course, as we have observed or mentioned earlier, that the national statistical offices and the customs, they work together on the preparation and cleaning of the data and, properly assigning or classifying each particular transaction in order to be then used in the method calculation. It is also important to know that when we use transaction level data, we should pay attention to use those before any adjustments are made to those types of data, to those data. In some cases, statistical authorities may correct the transaction level, so international trade data, for abnormal prices in order to have a better quality statistics from the trade transaction data. Those adjustments could be made to address the related partners transactions and to mark them as a arm's length prices. So those adjustments, of course, are important to have reliable trade level data or international trade data. But for our purposes, it is essentially important that we use really the raw data before any adjustments are made. So we mentioned earlier, so those are nationally acquired data from national authorities. However, in order to apply this method, some international sources could also be used. For example, when we said that we are looking at that we propose to be looking at a free market prices, of course, we have to source those free market prices from somewhere. There are a few data sources that could provide very good indication of what is a free market price. So we could use the UNCTAD's commodity prices, but also World Bank's commodity market prices are very useful. We also have from Comtrade, we have the standard unit values, which could to a certain level provide additional insights into a specific commodities in terms of the prices. But we also need to have additional insights from our national experts to refine those prices when and if they're needed. Very similarly to addressing the CIF-FOB ratio, which we had in the partner country method, also here, we could be essentially having those free market prices adjusted for specific circumstances. If it's a landlocked country, the free market price may not be fully applicable, as we may have to add a little bit of transport costs through a different country or something like this. So all these national specific circumstances or product commodity specific circumstances will also have to be brought into our considerations when we are doing this. Of course, if we use the transaction level data also to identify trading partners, so those entities or companies we are dealing with, specifically in trying to observe whether we are addressing them from a related partners or related parties transactions, we may need to bring other data sources like structural business statistics or anything like this into our considerations. So this will depend on data availability and of course of what can actually be done using those data sources. So we are now moving into the decalculation phase. So the first step in the calculation is to explore the data. So this is important to actually observe what data we have and what has to be done in order to clean those data and to make them ready for the analysis itself. We need to bring experts on board. We have to address various stakeholders in a country to actually observe what is a good data set. You may remember, so we said that the partner country method can be used as a first step, as a preliminary analysis, and then we can use price filter method as a more focused or narrowed down analysis. So since this method, of course, requires a lot of inputs, a lot of resources, we sometimes in practice cannot apply this method to every single commodity at a detailed level and so on. So we can rather have a focused analysis on, let's say, we will be looking at the one chapter of the HS, which has turned out to be more problematic, or trade with specific partners and so on. In the example or in a case study, which actually Kathy has also referred to on Friday, so that was a case study of using both methods, so partner country method and the price filter method in South Africa. The exploratory analysis and the preparation of data took 3 different steps, so to say. So in the first step, they were, observing the transaction level data, and it's actually having to do some sort of cleaning or even aggregations. So the transactions had to be first aggregated at the daily level, and they were using the 8-digit HS. So this was done to essentially come up with a unit observation, which would then be used for a analysis. They were also then in the second step aggregating into groups of similar trade. We have here, so by commodities, by partners, or in time. And the last would be to detect outliers and bring in experts on board to see what can be done with those outliers. Are they really outliers? Should they be removed, or should we somehow incorporate them into the analysis? So the outliers, of course, have a very strong effect on our results. Therefore, they have to be treated as in every other data sets, so to speak, with extreme caution. So once this is done, the next step, which of course is also taking place in the first step, but also in all the subsequent steps, is to involve international trade experts. So we need those experts to provide additional information both at the input and the output levels. And moreover, we have to keep in mind that essentially different commodities would require different experts. So depending on what our specific analysis would be, on which commodities we would be focusing, or on each trade flows and so on, we may be bringing different experts on board. And now we come to the very essential step of the price filter method. So this is the step or the phase of defining the price filter itself. So we will see, of course, there are multiple options, or not multiple, but let's say at least a few options, how to define the price filter. But regardless of that, the price filter is this kind of composed of 2 parts. We are doing a 2 steps process. The first one is to define the central price. And the second one is to define the range defined by this alpha. So how much up and down of this central price we can go within this price filter. So remember, price filter is a range of prices, and any prices that fall within this range are considered as normal prices. Any prices that fall outside of that range are considered as abnormal prices. So first, we have to make a decision on the price series that we are going to use throughout the application of the price filter methods. So we can either use the observed prices from these transactions that we are actually working on, or we can use the free market prices. So when we want to say what is the central price, so we have those 2 options. So using the observed prices has one obvious and very practical advantage. So we are using the same data source that we have already exploited in obtaining those transactions. However, we said that there is a major problem in using the observed prices is that the price filter constructed in that way could essentially produce a biased estimator. So free market prices, we mentioned earlier, are a way to limit this drawback. However, we may suffer from, being only applicable to a few commodities where a clear and commonly accepted market exists. Regardless, we say the free market prices should be used as much as possible. And the second point that we also have to address here is to what level of detail should we be addressing? So it is proposed to use a price at the most detailed product classification level. And if possible, to also bring on board those product descriptions that may sometimes be available next to the transactions to essentially account for those differences in qualities of products at the lowest level, so in the same category. And this is the point where we will, of course, require heavy involvement of those commodities or international trade experts. As a very brief example, so we're not going to go too much into it, but this is a case of how the price for gold has been determined, so as a benchmark price. It was noted, of course, that using various sources, the gold doré bars have different contents of gold. So even though that they would be classified into a single HS digit, they would differ depending on how much gold they actually have. And they could have, we can see here, from 2 to 95% of pure gold. And of course, this will drive the prices significantly up and down. So that's why they say, okay, so we will have a maximum benchmark price, which will be based on the contents and the prices of gold and silver in these gold doré bars, and the minimum benchmark price as well. So the maximum is, the gold is more expensive, so the maximum is essentially based on the gold content, so the maximum gold contents, whereas the lowest level, so the minimum price, has the minimum gold content included. So by doing this, we are essentially trying to address the prices that are varying within a specific commodity code. The next thing that we have to address when we are determining the price filter, so if I go back to slides, we are still discussing the central price. So we have to determine the central price. So first we said, use the free market prices as much as possible. Second, we said to use the most detailed product classification level, if possible, also with additional descriptions. And then the next question is on the time dimension. So we have two questions here. So first of all, which time frame should we be using? In the sense of, are we only including one, so the current price, or are we incorporating a longer period, to account for some of the variation in the market? And the second question is, so are we using a one value, so one fixed value for this entire period, whatever we have, this time frame we have discussed, or should we use some sort of a rolling value in this time, in this entire period? So the suggestion is to avoid using a fixed value for a longer period of time. You may remember we mentioned earlier, when we have an annual price filter, but then we have within this year strong or high volatility of our commodity. So to address this, it will be better to avoid a fixed value for a longer period. However, we would still say that it would be better to use multiple periods to account for more stability, or to account for those variations in time. So a proposal is to essentially use a moving average, so as a rolling value, a moving average for a shorter period, for example, 3 days. So 3-day moving average may be something worth exploring. And this is essentially also the procedure that has been used in the case study that will be applied and explained in the following sessions today. Next point is reporting and partner companies. Whenever possible, if we have, of course, the option, we should be observing transactions both for reporting and partner companies, in specifically in terms of determining whether this mispricing refers to free market circumstances, or is this the phenomena of transfer mispricing. So whether we're looking at a aggressive tax avoidance or whether we're looking at trade misinvoicing. So if we have those data available, it would be advisable to see what our trading partners as companies, as units, in fact are. Trying to obtain the expert knowledge would also be helpful in case when specific market conditions would impact the observed or true prices of the market. So we mentioned earlier the long-term contracts. So this is important for a specific transaction to identify, okay, this is a legitimate low price, and therefore we have to account for it as such and not count it as an abnormal price. A particular market condition has also been observed to be a domination of trade flows by the use of intermediaries that are located in tax havens or in other low tax jurisdictions. So this is, again, a very important implication stemming from the case study by Brazil, which we will be looking in the second session of today. So we should be observing those market conditions and making sure that we apply them the way that they should be applied in the method. So specifically when we are interpreting the results. So here is, I'm only gonna skim very briefly through this because we will have a better explanation and presentation of this later on, as mentioned. So the price filter method has been applied for a soya bean exports in Brazil. What can we observe here is that they used a 3-day weighted moving average price, and this is the way how they constructed the soya bean price filter. So with a price plus minus alpha, so as a range. And this chart, I think, is very beautiful, showing what the main message was. So that the prices at the lower end are the ones that are coming from these bluish, greenish parts. So these are intermediaries in tax havens or privileged tax regimes. So it shows that the low tax jurisdictions or partners are essentially responsible for the underpricing of this soya bean exports. So this is an important, of course, above all, policy implication, and this is what it should be done to be observed in the calculation of the price filter method. In the second price of the price, in the second phase of the defining the price filter, after we have accounted for the central price, which is here, we have to look into this alpha. So this is the amount of variation around the central price that we deemed as normal. So essentially, we have again here two main approaches, and the first one will be essentially as a result of using a statistical price filter, is defining a lower and the upper bound price. In the statistical price filter, usually it is used the interquartile range, which means that the lower price is defined as the first quartile or the 25th percentile, and the upper bound price is defined as the third quartile or the 75th percentile. Of course, we can apply other percentiles. So not the 25th and the 75th, we can apply also asymmetrical percentile. So the lower could be 25, but the upper could be only 90. This would depend on a specific case, and we would need to have expert inputs in order to define prices differently. In a case study that we referred to in the guidelines, so it was Ghana, the gold experts, or trade with Switzerland, I believe. I think that there was a asymmetric price filter applied. So this, of course, can happen. However, in the absence of any strong arguments against it, whenever using the statistical price filter, the interquartile range is essentially to be used. And by this, we define the lower bound price and the upper bound price, which means any prices falling lower than the lower bound price and any prices falling higher than the upper bound price would be considered as abnormal prices. The second option is to define the lower and the upper bound prices using the variation around the central price. So we have the lower bound prices defined as a central price minus alpha, and the upper bound price as a central price plus this alpha. So whenever we use the free market price filters, this is something that can be done. Now, in defining the alpha, of course, it is again crucial to involve experts to determine this alpha. So this alpha, this variation, would be accounting for, product-specific circumstances, price volatilities, any contractual terms, or any other business conditions, transportation costs, of course, if those things are relevant, but also for any political, economic, or environmental shocks that may be affecting the prices of a particular commodity in a particular time. And again, as here, any prices falling within this range, so between lower bound price and the upper bound price, are considered as normal prices. Anything falling outside of this range is considered as abnormal price. And this brings us to the calculation of the over and under pricing. So whenever we have a case that the price marked here as a P, so this is the actual price of a transaction, falls lower than the lower bound price. So this is here in the first line. We have the case of undervalued amount. So let's say that the lower bound price is 5 and our price is 3. Of course, so this is a lower price. So this is the case of undervaluation. So therefore, we take the maximum of 0 and 5 minus 3. So 0 and 2, so the maximum is 2. And we multiply this difference, the difference that we have observed by the quantity in that transaction to observe the undervalued amount. If the price is higher than the lower price, so the lower bound price is still 5, but our price that we have observed is 7. In this case, we do not have an undervaluation. So we have, if this is the case, 5 minus 7 is minus 2, which means that the maximum is 0, which means that the undervalued is 0. And conversely, the overvalued amount is when the price observed is higher than the upper bound price. If it is higher, then this is a positive thing. If it is lower, then this is negative, where therefore the maximum is 0, so the undervalued amount is 0. So whenever prices fall below the lower bound price, we have the undervaluation. Whenever the prices fall above the upper bound price, we have the case of overvaluation. If the prices are within the range defined by the lower bound price and the upper bound price, we have a case of normal prices. So no identification of mispricing. And finally, we can go to the phase of the calculation of the inward and outward illicit financial flows. Again, as was the case on Friday, we have to understand that the inward illicit financial flows are a composition of two cases: either overvaluation of exports or undervaluation of imports. So for those flows that are overvalued exports and undervalued imports, we sum those up and we obtain the value for the inward illicit financial flows. And for the outward illicit financial flows, so those are the flows that are leaving our country, those are the sum of undervalued exports or overvalued imports. So simply with a case, for example, undervalued exports, why is this the outward illicit financial flows? So when we have our commodity with a true value of 100 and we export it, but we only list 80 on our invoice. So what is essentially going on? A true value of 100 is leaving our country and only 80 are coming into the country through this invoice. But the rest, 20, are being paid by the purchaser, let's say, to our offshore account. So those 20 have essentially left our country, and that's why they are the undervalued amount of exports, and they constitute the outward illicit financial flows. And similarly to the overvaluation of imports, is we are essentially importing a good or a commodity with a true value of 100, but we are importing it at the value of 120. So we are essentially paying 120 to somebody abroad for bringing only 100 into our country. And this 100 is being paid to the purchaser outside of the country, but the remaining 20 is being put on, let's say, our offshore account or somebody else. So similarly, as in partner country method, the inward and the outward IFFs are not linked only to the imports and exports, but to both. Okay, so I'm going to stop here. I hope that this was not too boring and people are still around. So Kathy, I'm gonna hand over to you for any potential questions or anything with this. Thank you.
Thanks, Bojan. Thank you very much. I think that was very useful. I don't see any hands. Can we open up? I do. Viola?
Yeah, thank you so much, Bojan, again. Thanks for the details and all the calculation of the inflow and outflow. So I have concerns about technology pricing. When you have the ICT telcos telling you softwares, the costs declared on softwares and other types of service-related components, especially in the area of technology. How do we verify, validate, and know the actual cost of these technologies, since those technologies are not, most of them are not off the shelf. Maybe sometimes they are custom built, and the pricing around this is very easily exploited. So my mind is just walking around, how can we have this aspect of transactions well costed and determined in value? Thank you.
Are there any more questions? I mean, I don't really see any other hands. Maybe if we can take another question or two and then Bojan can answer. Clearly it's Monday morning and the end of a process, so maybe people are very tired and getting ready for the holidays. I don't see anything else from my side, Bojan. Maybe if you can just answer that.
Yeah, sounds good. I think it sounds very good to be discussing holidays on Monday morning.
Exactly.
But yeah, I mean, honestly, to answer that question, I think it is a very specific question. Yeah, of course, and complex in that regard. So there is no easy solution for that. It would be my understanding or idea to go around this to essentially involve the experts in this field, to bring them on board and say, okay, is this price reasonable? Does this make sense? And they would have a more better understanding and picture of saying, look, this price is okay, or no, this price is not okay. The main problem with the price filter method is essentially not the application itself. I mean, we can see that the concept is very simple. You know, you have the price range, and everything that falls outside of it is mispricing. But the main problem is to determine this range, essentially. So for each specific commodity, we have to have a price filter, and this one has to be determined with, you know, sometimes years of experience to understanding what is essentially going on. So therefore, I think my only answer to that would be specific experts would have to be brought into the picture and say, this price makes sense. No, this is way too pricey, or this is way too underpriced. Yeah, sorry, I don't have any more concrete response to that. I hope it still helps.
I think it does. And I mean, the reality is that you have to drill down at a product level into a lot of detail. And that, I think, is where it gets very complex in this process. Are there any other questions? I see no hands and I see nothing in the chat. It is 11, so I think if I'm not seeing anything. So I think if that's the case, Amandine, can we go into our coffee break and then reconvene in 30 minutes? And then by that stage, our Brazil colleagues will actually be online, and we can actually move into the actual case study, the detailed case study, and the actual tutorial session. Is that okay?
Yes.
Great. Thanks, Amandine.
Yeah, I think it's great. I actually see Pedro and Luciana have already joined in, which is great. So good morning to both of you. I think it's just best to have a break of 30 minutes. Maybe we could say that, so the material that was prepared for today's session has been posted online on the website. So on the link that was shared earlier in the morning, if you go to that website and under the documents, you will find for today's date, so for method number 2, December 13, a few Excel files and some links that Pedro will be using in his example session. So maybe you can use this 30 minutes break to download, to navigate to the website, to download the files, and to be ready for the next session when we start at 10:30 CET, which means in 30 minutes. Yeah.
I think there's just one file
One
that is not on the web page that we need to convert.
And there is a
One
question, Papa Leone. It says, my question is about gold and silver content data. Apart from producing companies, where could we find such data? Do you want to maybe elaborate on your question?
Hello.
We can hear you.
You can hear me?
Yes.
100%.
Okay. So much of the time, the Dore bars, you have the content at the export point. So from the mine exit, but most of the time, the administration, apart from maybe customs, there is no source of data for analysis. If you can see what I mean.
Okay, and so that's very specific sort of on that. Bojan, any ideas on that?
Well, I mean, unfortunately, I'm not, an expert in this thing, so I wouldn't know exactly where to be looking for those data. So in the case study that we had earlier, so it was a case that was done in Ghana and the trade of gold with Switzerland mostly. So they were referring to the prices, to the London Bullion Market Associates. So they have a daily prices quotes there, and they were using those so prices that were being quoted there. So I think those specialized specifically for metals. There are a few of those. The London Metal Exchange or this London Bullion Market Association. So those would be potentially good leads, or at least starting points for a free market price of those commodities.
Carlotta, I don't know if I know you're online, but if you, maybe you've got some insights, because I mean, you've done quite a bit of work specifically looking at extractives.
So basically, I think that what I understood as well from the case study of Ghana is that they found that specific mines have a specific percentage of silver and gold in the product, meaning that that company who's operating that mine, because here we're looking at transaction level data, will then also have similar prices when at customs. So if you know which companies are operating in which mine, that already gives you an indicator of what kind of quality product you might be expecting them to export. I hope that helps.
Is that good? But Leonie, thank you very much. I see Andeshak has a question, which is more a process question, which is really, given that COVID is a challenge and there's a need for an expert to be invited during the pilot testing of the measurement of IFFs using this method. Bojan, do you want to cover that?
Yeah, sure. I mean, of course, COVID has caused everybody a lot of strains of how to get about it. So even today's training ideally would be in person with, more in-depth cases. However, we have what we have right now. Of course, I mean, I think, especially within the country, it might be essentially, it has proven that it might not be so difficult to bring people on board and to have discussions and work together, sharing the files, using Zoom and so on. So I think there are ways to go around it. Not necessarily to meet in person, although sometimes it is, of course, easier. So I think I can only respond with this, that please exploit other options, Zoom calls, sharing of files via emails and so on. It might not be as efficient, I fully agree, but I don't think there's any other way around it.
Thanks, Bojan. Maybe to Andeshak, your country, the experts have actually been appointed per country. Are you looking for additional expertise?
I'm just asking generally. Just
Okay.
asking generally. Yeah.
Super. Okay.
Yeah.
Great. I don't see, thank you. I don't see any more questions. So if we can actually download all of the documents as we had advised you to do. I'm actually going to hand over to Luciana, who actually works at the Ministry of Finance in Brazil and has been working on developing this particular case study and refining it. So Luciana, over to you. And then I'm assuming Pedro will come in after that, or is he going to, are you going to do it interactively, sort of one after the other? We're not going to take another break.
Good morning, everyone. Good morning, Kathy. I think I will start explaining the case study, and then afterwards, Pedro will explain the Python code and do the exercise, I think.
Perfect. Super.
Okay,
Thanks
so
much.
I will share my screen. Please just let me know if you can see it.
I'll just remind and ask you if you can also speak not too fast for the interpreters.
Okay. Okay.
Just while you are presenting.
Okay.
Thank you and hi.
Hi. Just a minute. I think I have to share my screen. Just a minute. Okay. I think. Okay. I don't know if you can see my. Can you see my screen?
No, not yet.
Not
No.
yet.
Amandine, I think
Okay.
you're. Oh yeah, now it's
Oh,
coming
wait,
up.
something's happening.
Yeah.
Yeah, there we got it. We've got it. Just
right.
maybe move the slides so that I can just see that it is. Oh, it's going to play. Perfect. Okay, it's looking good.
Okay. Just a minute. All right. Well, good morning, everyone. I would like to briefly introduce myself. My name is Luciana Barcarolo, and I have been working as a tax auditor for the Federal Revenue and Customs Services of Brazil for almost 15 years. And I have experience in the areas of research and targeting abusive tax planning schemes for audit proceedings, and also targeting trading companies for post-clearance audit proceedings. Well, I would like to thank UNCTAD for this opportunity to share our research and experience applying the price filter method to estimate the potential amount of underinvoiced export transactions related to what we have called the phantom trade phenomenon. Well, I will briefly explain how we started our work in Brazil. So in 2017, the Federal Police of Brazil sent a report to the Federal Revenue pointing out that some companies would be involved in underinvoiced exports to shell corporations located in tax havens that might result in tax evasion. And during that year, the Federal Revenue started an investigation to confirm if the international trade system had been exploited to conceal trade profits in low tax jurisdictions. In 2018, the Federal Revenue launched a research team on illicit financial flows via trade misinvoicing, with experts from customs, tax, and financial intelligence aimed to develop risk exposure analysis and integrated actions as well. In 2020, the price filter method was used to estimate the potential underinvoiced amount or price anomalies in export transactions. Now in 2021, the partner country method and the profit shifting method based on semi-elasticities have been also tested with promising results. And all these statistical methodologies have been also applied in a risk analysis tool, which has been called BEPS Analytics, with the aim to assess profit shifting risks in different types of cross-border transactions. Well, our risk analysis approach was based on audited cases such as this one, which illustrates how phantom corporations or empty corporate shells with no real economic substance or activity likely have been used as reinvoicing centers in order to divert the payments or financial flows of trade transactions to low tax jurisdictions. It is important to notice that in triangular or indirect export transactions like this one, the country of acquisition, which in this case is a tax haven or a privileged tax regime, is different from the country of destination. So the commodities are shipped directly from country A, the exporter, to different final destinations. And as a result, through the undervalued export transactions to shell corporations, the entity A accumulates undeclared profits in low tax jurisdictions or other offshore bank accounts, reducing its tax liabilities in country A. However, it is important to notice that according to our experience, it would be necessary to carry out a specific tax audit proceeding to identify case by case and according to the evidence collected and also the national legal framework in force, if the suspicious transactions with offshore corporate intermediaries enable tax evasion or aggressive tax planning. Well, so based on this case study, the focus of our research was to identify profit shifting opportunities or tax evasion risks by estimating the amount of abnormal underinvoiced prices in the soybean trade market. Well, as already mentioned by Bojan, the price filter method is used to detect suspicious transactions with abnormal prices, which would be an indication of possible trade mispricing. So the price filter may be constructed from observable market prices or may be statistically estimated using transaction level trade data. And for the purposes of our research, the price filter for the soybean trade market was statistically estimated using a 3-day weighted moving average price built on transaction level trade data collected by the Customs Bureau and for a specific commodity HS code at the 8-digit level of aggregation. So for example, in this simplified infographic, we have a daily data series of export transactions, and each bubble or each dot represents one export transaction and the corresponding sale price as reported by the exporters to the Customs Bureau. So before estimating the weighted moving average price, an outlier treatment was applied using the interquartile range. So all export transactions which are more than 1.5 times the interquartile range above the quartile 3 or below the quartile 1 were excluded from the daily data series. The price filter was statistically estimated using the 3-day weighted moving average price, which was built on transaction level trade data such as invoice prices, the quantity in tons, the number of exporters, and the number of export transactions. The upper and lower bound prices were set at the three-day weighted moving average, plus or minus one standard deviation. And the underinvoiced amount in export transactions, which was the focus of our research, was estimated as the lower bound price minus invoice price times quantity. So the assumption of our research is that the undervalued export transactions or are abnormally underpriced transactions in relation to the lower bound price likely enables profit shifting out of countries. And as a result, the total underinvoiced amount in export transactions corresponds to the estimated tax-related illicit financial outflows or potential profit shifting. Well, so applying this methodology, the daily data series of transaction level invoice prices were segregated by quartiles, and the statistically estimated price filter range for the soybean trade market was plotted in black, as you can see in this chart. The export transactions below the lower bound indicate suspicious, abnormally underpriced invoices. And according to our to the assumptions of our research, which were based on the Phantom trade case study, the transaction level invoice prices classified in the quartile 1, which are highlighted here in red, would be the most exposed to the trade mispricing or profit shifting opportunities through the use of offshore intermediary entities located in low tax jurisdictions. So considering that these entities are potentially used as financial conduits in the routing of commercial financial flows, the next step of our research was to assess the economic substance of these offshore hubs in order to understand the potential profit shifting risks and related artificial financial flows. So as an initial proxy to assess the economic substance or artificiality of the intermediary entities potentially used as reinvoicing centers, the transaction level invoice prices plotted in the chart that were considered at a high risk exposure to trade mispricing or profit shifting opportunities were segregated by type of transaction and classified as a triangular or a direct transaction. And also these high risk exposure export transactions were segregated also by type of country of acquisition, which were classified as tax haven, privileged tax regime, or other jurisdictions. So as you can see in this chart, almost all abnormally underpriced export transactions in the quartile 1 are plotted in light or dark blue, which means that almost all export transactions are intermediated by entities located in tax havens or privileged tax regimes. Considering all export transactions, not only the transactions below the lower bound price, it was estimated that more than 90% of the export transactions rely on operations intermediated by entities located in low tax jurisdictions. And this illustrates a very high reliance on tax minimizing routes possibly enabled by intermediary empty corporate shells with no real commercial activities. This finding also means a red flag warning, because the price filter, which was statistically estimated using the transaction level trade data, likely would be biased down by cross-border aggressive tax planning strategies or even tax evasion practices. Well, as a result, the estimated underinvoiced amount in export transactions would be biased down as well. So the first conclusion of our research is that if a considerable amount of export transactions relies on triangular operations through offshore intermediary entities located in low tax jurisdictions, the statistically estimated price filter wouldn't be the most appropriated one. So as an alternative, the price filter could be constructed based on other databases such as the IMF Primary Commodity Prices database, or based on prices reported by relevant trade partners, such as the prices reported in the UNCTAD database. Well, however, it is important to notice that even through a conservative or even biased down estimate, it was possible to observe financial flows with high levels of high risk exposure to profit shifting or trade mispricing. The research also indicates that low tax jurisdictions and the lack of transparency likely play relevant key roles as drivers of the phantom trade phenomenon. And finally, it is important to say that the OECD country-by-country reports contain useful information on the level of revenues, profits, number of employees, and economic activities, which might be used as indicators that companies have entities in low tax jurisdictions with disproportionate earnings in relation to their level of economic activity. Well, now my colleague Pedro will explain the Python code used to build the price filter and estimate the underinvoiced amount in export transactions. And also afterwards, Pedro will make a practical exercise using Excel. And I think we'll have a little break between these two parts after Pedro explained the Python code. Well, I hope everyone has already downloaded the material, which is available on the website of the training. Well, and if you have any doubt, please ask us during the exercise and we'll be willing to help you. So Pedro, I'll give you the floor.
Okay, good morning to all of you. Let me share my screen. Okay. Do you see my screen?
Not
yet.
Not yet.
No?
No.
Not yet.
Let me see. I have 3 monitors here. Then
I think you should share the screen too, Pedro.
Something's happening, Pedro. There we go.
Yeah.
It's on. Thank you.
Yeah, thank you.
it's okay now? No.
Yes, we can see your screen.
Yeah.
Yeah. Okay. Do you see price filter method? Yeah.
Yes. Yeah.
Okay. Well. Well, my name is Pedro. I'm working in Federal Revenue Service and Customs of Brazil for 16 years. I have experience in audit selection and last time I am working with data science because it's a field that is growing in Brazil. And I have been working with Luciana with the system called BEPS Analytics that is very, very exciting because we are working with artificial intelligence, complex network analysis, and price filter method and partner company method too. And because this, I am going to present in this time frame that we have two things related to price filter method. Firstly, I will present a script in Python language which extracts transaction data from exports and manipulates the data to calculate the price filter. Afterward, I will do a simple exercise in Excel, which you will be able to follow, and whoever wants can do it as well while I explain. I think I will do a time to you make this exercise, and then I will explain if you have time only. I believe that both the script explanation and the exercise will make you fix and better understand the price filter method concepts. Then let's start with price filter method in Python code. This script is available in Google Colab. If you want, you can use it. Just access the link you received, and you will enter in this screen that you are seeing. I advise you to do this after this module. I think it's important to try to understand what was done. If you access the link, you will enter the screen. This is Google Colab. Google Colab is a collaborative environment created by Google. Here we can share code, scripts, and so on. And that's why what I did here. I produced a simple code where I present the price filter calculation. If you enter the link, you can use the code and even change it according to your needs. We made it especially for this training. Then on Google Colab, above, there is a menu of some features here. In the body, it has the code itself here. On left, there is a folder here. Then the first thing I will do is upload the data so it can be worked on by the script. I click this folder, and then I click the upload icon above to open my database, and I will choose the exercise PFM. Is a file that you receive in the files that were sent. Then the exercise PFM is here, and we can start to execute our script. Okay. Anyone who wants can repeat this exercise later. Just enter this link and you can make it. I will close here, and here is the code. Each of these blocks here is a snippet of script that can be run independently. To execute the block, click this icon here. Okay. Then I will execute the code. The first block is a load of the Python package needed to run the script. I click here, and okay, the package was loaded. Then I will load the data to script. The data will be imported from the the file that we uploaded now, and just will be loaded to Python manipulate. Here, I call it df. Okay, the Python load the exercise PFM CSV, and then we can spec it. I will do this with these two commands, the first lines and the last lines. Do you see that this file have 0 to 1,699 lines? This is the number of transactions of our file. Is in a period of September 2014, 1 to 22 days of our window. In the first column, we have the transaction date, 22 days. You have two metrics here: quantity, ton, and value. This is a commodity file used in Brazil and was masked because the secrecy file. We mark it in last column the type of jurisdiction: tax haven, privileged tax region, or other jurisdiction. And here we have a country of acquisition, where is the financial flow, and country of destination, goods flow, and the name of company. Then this is the file that we work to calculate the price filter method. Here I put a command to calculate the number of operation, 1,700 operation in our file. Here I will inspect the file. We have two metrics of numbers, quantity and value, and strings, object strings. But to manipulate this data, I need to convert this date to datetime format in Python, because Python needs datetime format to calculate time frames. This is I made here in this part of code. I execute, and then I have datetime formatting here. Now the file is ready to calculate the price filter method. The first thing we calculate is the transaction type, whether direct or indirect. It will be direct if the country of acquisition is the same as the destination, as Luciana explained. Otherwise, it will be triangular or indirect. I name the type of transaction and do the calculation in this cell, type of transaction. This cell will calculate. I will run, and you can see that now our file have a new column, type of transaction, explaining which kind of transaction is. If the country is different, it's triangular. All of these first lines are triangular, indirect. Next step is to calculate the transaction price. We have the quantity, here, and the total value of operation here. But we need the price at which it took place. For that, we added a new column in our data frame. We simply divide the transaction value by the quantity and obtain the price in US dollar per ton. This is made in this cell. I call it US by ton and divide value by quantity ton. And then new column was added to our database and show the price of operation of each operation. I only present here the first lines, but I can in Python code show more if I want. Here I show 10 lines. I can show the last lines too, only to inspect the file. Okay. Then I will plot a graph of our prices to see how can look that. I have the price, we plot the graph. Every point on this graph is a transaction. Every dot blue is a transaction. There is 1,700 dots on it. Each vertical line is a day. We have 22 days here. On the epsilon axis, we have the price. Do you see that the price is a range about 300, 420 days? And look at the last day is a particular day because the prices are in a very low range, different of the other days. This is important later when you use the moving average to calculate the price filter method. We see later. Now that we have the prices, we are going to calculate the quantity weighted average. Here we present the formula for the weighted average. It is the sum of the multiplication of the quantity by the price divided by the sum of the quantity. This is the same thing as making the sum of the operation value divided by the sum of the quantity. And that's what we are going to do in the next cells. The sum of the value by the sum of the quantity tons. I need to create a new data frame, call it grouping, to do this, because I will aggregate by day the quantity, ton, and the value by sum. Look that this new data frame sum the quantity and the value by day to calculate our weighted average. To calculate the weighted average, I divided value of the grouping day by quantity ton. And then I have a weighted average by day after this calculation. Is a new column in our grouping head. I will change the names of the grouping to don't confuse with our original data frame. Quantity, I will call it G, and now and value G to difference. And now I will plot the weighted average by day that I calculate. Look that. If you look at the chart as a whole, you will see that the transaction that took place on that day had low value, and the last day had low values. But if we consider the daily weighted average, the price filter range will not consider this operation as suspicious. An alternative to dealing with this situation is to attenuate the median. In our case, we use a 3-day weighted average, and that is the next calculation. Look that this last day is a particular day. When I use daily weighted average, the last day, the weighted average is so low. Then if we use later the price filter method, all the operations of these days will lie in the normal bond, is inside the normal bond. Then we must use some average to attenuate these points, and that's the next calculation. Here, in this, here I simply calculate the median, the average by 3 days. Instead of 1 day, is attenuated by moving average by 3 days. And in the right is the calculator weighted average 3 days, is a average smoothed. I will plot, and do you see the red point, the red dots is average 3 days, 3 days moving average. The black dot is a 1 day weighted average. Look that last day is better now because later the price filter will, the transaction on this date will lie outside the lower bound and declared suspicious. Then this average 3 days will be used to calculate our price filter range, these red points. Now that we have the weighted 3 days average, we will calculate the standard deviation needed to our work, as Luciana told earlier, that we use in Brazil standard deviations as alpha. We will also use a 3-day range to calculate the standard deviation. Then I will do this now. This next cells calculates the standard deviation of 3 days and presents here. Each day has a standard deviation of the prices. This standard deviation we'll use to calculate our price filter range. I will merge our grouping data frame with this standard deviation data frame and include standard deviation in our grouping head. Then we have the weighted average 3 days here and the standard deviation here. This is necessary to calculate the lower bound and upper bound of price filter method. And now we're ready to calculate The lower bound is the weighted average minus standard deviation. The upper bound is weighted average plus standard deviation. And this cell is made it grouping. Lower bound is a weighted average minus standard deviation. Upper bound is weighted average 3 days plus standard deviation. And then we have in our grouping the calculus of lower bound in this column and upper bound in this column. And then I will plot, looked at our price filter range. And line is a lower bound. And the orange dots in up is upper bound. Is interest to our work the lower bound because we are interested in prices below this range, these prices here. The next step is to calculate which transactions are below the lower bound, these transactions here. For that, I embed the data frame group in the original data frame. The original data frame DF has all the transactions, and our grouping are aggregate by day. But I need to incorporate the lower bound and the upper bound in data frame to calculate the transactions below the lower bound. I made it here. Then our original database, it has each operation, each transaction has now lower bound and upper bound. And then I will calculate which price lie below the lower bound. This cell made this. And then we have a new column here, price below, and some of the operation lies below the lower bound. These first 5 operations lies below the upper bound. If I call the last operations, let me see. Two. The last operations 2 lies on lower bound. I will plot the new graph with the operation lie below lower bound. See in the graph, the brown dots are the transactions that occur below the lower bound. This transaction here. This is transaction that we are searching that are suspicious by price filter methods. Now I will calculate the potential underinvoiced amount for this operation here. First, I calculate the difference between lower bound or the orange line and price below, and the price is brown, dot browns. This distance from points of orange and dots of browns are the difference that will be calculated in potential underinvoiced amount. I will make this in this cell. And then I will calculate the potential underinvoiced amount. Is the difference that I will calculate by times quantity in tons. And then I can sum, and the result is the potential underinvoiced amount of these 22 days calculated by price filter method. I can show this in a histogram. You can see most of operations lies in the so few potential, but some operations, 3 of that, are very, very large operations that may be must to be inspected. But these operations too are suspect. But this is the work that we made in Brazil, which this database is based on our work, was masked, but is very, very similar to our database. And this script is a step-by-step what we made here. But here we didn't make outlier detection, but in the next exercise in Excel, we will make outlier detection. This is our work. It's if someone has a question, okay. I suggest then a short break to next make the exercise in Excel.
Thanks so much, Pedro and Luciana. That was really quite fascinating and a very nice step-by-step run through. I don't see any questions. Just like to point everybody to Bojan's comment in the chat regarding that it's not possible to upload a CSV file on the web platform and that you have to convert it into Excel first. Any questions? No, yes, nothing.
Just Kathy, I think just about the file is in Excel and they have to convert it in CSV.
CSV,
yeah. It's the other way around.
Said? I see your hand is up. Said Dade, do you want to ask your question?
Yes.
I think you're back on mute again, Said.
Sorry. Yeah,
okay, we can hear you now.
Okay. Now, vou falar em português. Muito obrigado, Pedro e...
I will speak in Portuguese. Thank you very much, Pedro and Luciana, for this beautiful presentation and sharing the experience of Brazil. I just wanted to, I don't know if my worry is directed to Luciana or Pedro or the organizers for this UNCTAD meeting. From the time we joined at the beginning of this training, I can say in parentheses, we've been a bit punished. Sorry, there was an interference there. I was saying that we have been punished by, because up to date, These materials not available in Portuguese language. And having listened to Luciana and Pedro here talking about these documents being translated to English, I wanted to find out if it's not possible for them to avail this material that is coming from Brazil, which is in the language that they use, because it would facilitate our life for us. Thank you very much.
I'm not sure who's going to handle that. Pedro, maybe you can tackle that?
Yes, vou falar em português para o site. Podemos disponibilizar sim.
I can speak the Saidian project. Yes, we can avail our material for us. Thank you very much.
He asked me to send the material in Portuguese language, and we will translate to Portuguese to send you.
Thank you very much.
Muito obrigado. Então, neste caso, vai ser.
Thank you very much. At this point, I don't know if it will be a bilateral sharing or to be through the organizers.
He asked me if UNCTAD will send you or Brazil will send you to Portuguese translation.
Yes, you can send them to us, Pedro, and we will sharing them.
Circulate. Yeah.
Okay.
Thank you.
Vai encaminhar para eles e encaminhar para vocês.
Yeah, thank you, Pedro. Obrigado.
Thank you very much. I don't see any more questions. Do you still want to take a few minutes as a break, or are you ready to proceed? You want to take 10 minutes?
I think a break is a good idea.
Okay. Okay. Silvestre, Andre?
Yes. Boa tarde.
Afternoon. Can I speak in Portuguese?
Absolutely. Go ahead.
Dear colleagues, you said that from Brazil you identified this misinvoicing through research that the federal police undertook. And after that, you developed a model for you to be able to try and see what you could identify and the rest of all that. My question is as follows. I wanted to find out with this exchange of information that the federal police got this information, or the federal police actually heard some news about what is happening in the rest of the world. How did the federal police get to this position that ended up developing into this scenario where you developed this model?
Bom dia, André. Também vou responder em português. Enfim,
Okay, I will answer in Portuguese. The federal police, they receive notices and notices that involve tax avoidances and anything that may require investigations. The federal police will send these notices to us, and it was through this that the police received this announcement, and they sent this to the taxation authorities in Brazil. And we also analyze a lot of things, including analysis of risks internally, so that we can actually work and resolve this kind of risks where we see profit shifting, especially for international operations. And especially in this case where we're looking at international business. We shouldn't always just wait for announcements from the federal police or any other internal body of Brazil.
Okay, obrigado, muito obrigado.
Okay, thank you very much.
Thank you. I don't see any more questions. So can we take a 5-minute body break? Is that okay? and then come back at 12:30 to actually start the next exercise, if that's okay with everybody.
Yes.
And then you'll just post it in the chat. Anastasia will actually address your question as soon as we come back. Pedro and them will actually just pay attention to that, and we'll address it. So just a 5-minute break, and then we'll start again. Right, I'd like to welcome everybody back for the last leg of this. Pedro is going to present the PFM methodology, but in Excel. Pedro, over to you. Just one question. Anastasia, do you want to quickly ask your question so that Luciana and Pedro can answer it?
Yes, thank you very much. Question was that in the previous methodologies, we saw interquartile range uses the reference for determining the filter. In this one, it was mentioned that ±1 standard deviation is used. So is there any like principal differences? Which one to use as reference? Because there are other approaches also. I have not seen other approaches used towards price filter, but I'm still interested if which one is more preferred, and so what to use better. Just the authors.
Super,
Hi,
thanks.
Anastasia. Well, you're right. There is no fixed rule for specifying the range. I think it depends on the commodity you are analyzing. In our case, we decided to use one standard deviation, but we have also made different studies using different ranges. So I suggest that you try different approaches and see which one fits better to the data set you are analyzing. I think it really depends on the commodity you are analyzing. That's why I think even Bojan in the first presentation said it is important to consult experts to understand better that market. You know, if you are analyzing the commodity, the agricultural commodity sector or the mining sector, each commodity has its specificities, you know. And I think the first thing I suggest is to understand that market and even try to understand issues related to what we showed in our case study, tax minimizing routes used, so you can decide if it's a good idea or not to use a price filter statistically estimated, or if the database might be priced down, and try to use different approaches such as the partner country method or other kind of observable market prices to define the price filter, you know. So there is no fixed solution. We are presenting what we made in our research, but I think you should really try to first understand the market or the commodity sector you are analyzing and try different ranges. I don't know if you have any other question.
Okay, so were there any distributional tests done before actually applying the filter? Because if we are relying on standard deviation, probably we assume a certain shape of distribution. If we're not, then we probably do not have any distributional assumptions. So before deciding about the filter to be used, do we normally, because I'm not using this method normally, do we normally do distributional tests on the daily price distributions on those commodities?
Oh, I think you can do or test the distribution in the model you will do. As I said, there is no just one way to do to apply the price filter. Well, I don't know if Pedro has something to add. I don't know if Pedro came back.
No, I don't have nothing.
Okay.
Okay, thank you.
Super, thanks so much. Pedro, I'm handing over to you to take us through the Excel.
Okay.
Thank you.
Well, next step is the Excel exercises. I think I will show you the steps of the exercise and will give time to you make the exercise, and then I will make the exercise myself, because I think it's important to you try to do this and to fix the concept. I don't know if all of you have Excel, but the exercise is in Excel, is this file. You receive two files, one called exercise, other called exercise answers. Exercise answers has all the solutions of this exercise, but I suggest that you start with file exercise to try to do this exercise to fix the concept. If you look the Excel exercise file do you receive, you can look items above and exercise the first this first exercise is the original file that we work in the last Python code. Only one difference, this file here in Excel has only 3 days to simplify the exercise. Has 3 days of operations, 140 lines, with the same data of the Python package. Every item here is an item of suggested exercise that we have in Word file do you receive. This file you receive too. If people speak in Portuguese, if you want that I explain in Portuguese later, you can call me, I explain in Portuguese later. But now I will explain in English to you. The first item we ask to you, define the type of each export transaction taking into account the country of acquisition, financial flow, and country of destination, goods flow. If the transaction is direct or triangular indirect. Here is an image suggesting that direct is a goods flow directly to country B, and financial flows is direct from country B to A. And triangular, the goods flow directly from A to B, but the financial flow pass through country C to country A. Is a triangular operation. Second item, we ask to calculate the prices of the operation, US dollar by ton. We made this in Python code too, but now we will make in Excel. Third, detect the outlier. This detection of outlier we didn't make in Python code, but we will make here. Drop the outliers is the fourth item. 5, calculate the weighted average price by day. 1 day weighted average. 6, insert the weighted average price in the sheet. 7, calculate the standard deviation of price by day. 8, insert the standard deviation of price in the sheet. 9, statistically estimate the price filter using the weighted average price and set the upper and lower bound price using the standard deviation. Here we don't use the 3 weighted average to simplify the exercise, but I suggest when you use in your country, you use 3-day average because it's smoothed. 10, identify the transaction level invoice prices below the lower bound price in the period. 11, calculate the difference between the lower bound prices and transaction level invoice prices below the lower bound in the period and estimate the potential underinvoiced amount or undervalued export transactions, abnormally underpriced transactions in relation to the lower bound price. 12, calculate the percentage of triangular indirect transactions with low tax jurisdiction, tax havens, or privileged tax regimes. And 13, based on the calculated percentage of triangular indirect transaction with low tax jurisdiction, answer. The price filter statistically estimated using transaction level trade data collected by the Customs Bureau might be based down by cross-border aggressive tax planning strategies. Alternatively, which databases might be used to construct the price filter? Reference UNCTAD database, the link is here. IMF primary commodity price database, link is here. This is the exercise. If you look the Excel file, you will find every item here. If you do not get answered one item, you can pass to next item because they are independently. The answer of item 1 is post in item 2, and so on. I suggest then you start the exercise. I will, we have a time, I think 30 minutes to you make this exercise. You can ask me about doubts, and you can, I suggest that you start with item 1. Okay? You understand?
Yes,
Thanks.
I think so.
Pedro, I think that was very clear. I see there's a request that the files be mailed. You can download them on the link that has been provided by both Bojan and Amandine. So if you can please just click on the link and go to the documents link or the documents file or tab, you'll actually be able to get all of the documents there.
Gotcha. I can
Yes.
explain to every item in Excel file too, if you desire, or it's okay.
I think we can be, I mean, I don't know if you want to go through that. I mean, I thought it was quite clear, but I think maybe it might be better to sort of go through that slowly, Pedro. So I think maybe just tackle each item slowly. Can we do that?
Okay.
Thank you. And if there are any questions, just to the participants, they can just sort of post it in the chat or raise their hands. But over to you, Pedro.
The first item is define the type of each export transaction. If you look the Excel file, item 1, you see the yellow column here. Here you put the answer. It's a calc of Excel, and you must compare this country with this country. Calculate here. You put here, and the calculus must show which kind of transaction is this transaction, if indirect or direct. Okay. The item 2 is calculate the prices. This item 2 here has a column in yellow. Here you will put the answer. You will calculate the price by the metrics do you have here, as we made in the Python code.
Pedro, I'm sorry. Can I stop you? I have just a brief question. If you go back to item number 1 in Excel, so essentially what we have to put in there is either direct or indirect transaction, right?
Yes.
Okay, so and a direct one is when the country of acquisition and country of destination are the same. Is that correct?
Yes,
okay.
Correct.
So we should be typing in like the if formula and getting the results.
Yes.
Okay. Thanks.
Here I will you use you can use a formula if. In English is if, in Portuguese is se. If the country are equal, country E is direct. If country A is different of country E is indirect. Item 2, I will calculate the price by a formula, dividing value by quantity Three, detect the outliers. And item 3, we will detect the outliers here in this column by this formula. I put this image to show you how to calculate. Is an interquartile range. We have the first quartile here and third quartile here. 50% of our dots lie on this range. To cut the outliers, we will use the formula of quartile 1 minus 1.5 times IQR. Interquartile range is third quartile minus first quartile. And the upper bound is a third quartile plus 1.5 times interquartile range, is this point here. This is asked to you calculate here. I will show you later how to do this, but if you try, if you can try, you can make it. But if you don't get do this, I will explain later. Here in item 4. We ask you to drop the outliers that we calculate in third item. Item 5, calculate the weighted average price by day. The formula of weighted average is here, is the sum of the quantity times price by day divided by the sum of the quantity, is the weighted average by day. Item 6, insert the weighted average price in the sheet. Then the weighted average we calculate here, we ask you to insert here in our sheet. Item 7, calculate the standard deviation of price by day. Item 7, we have the price by day here, and we must calculate the standard deviation by day to our formula of price filter. Eight, insert the standard deviation of price in the sheet. We ask you to insert standard deviation here in yellow to calculate the price filter method. 9, statistically estimate the price filter using the weighted average price and set the upper and lower bound prices using the standard deviation. Then here we ask you to calculate upper and lower bound. Lower bound is weighted average minus standard deviation. Upper bound is weighted average plus standard deviation. Item 10, identify the transaction level invoice price below the lower bound in the period. Here, we ask you to verify if the price is below the lower bound prices. This is the price, the lower bound. If the price is below the lower bound, we ask you to put the price here. If not, put 0 here. Eleven, calculate the difference between the lower bound price and transaction level invoice prices below the lower bound in the period and estimate the potential underinvoices amount of undervalued export transactions. Here, we ask you to calculate the difference between transaction level invoice and lower bound, and put the difference here and calculate the potential under invoices. This is a difference times quantity. This is a potential under invoices. And 12, calculate percentual of triangular and indirect transaction with low tax jurisdictions. This is here. We ask here. I asked Bojan if we need a time to people, to colleagues answer this exercise, or I will go slowly making it. I don't know if we have time, or I will make it.
I don't know. Honestly, I think it might actually be best. I think we still have some time, so maybe we can just go slowly, step by step, and you do show some of the calculations. Unless, I don't know, Kathy or Emmeline have any other ideas, but I think we can essentially go slowly, step by step, and you show the calculations, and then the participants will still have the time to follow up and use your solutions file as well, in case of any additional questions or when they do it at homes.
Because normally we finish in 1 hour.
Yeah.
That's the time on the agenda. So then we can see how we move forward with the exercise.
So Pedro, if this makes sense to you, and if Kathy has no objections, maybe we can just go item by item, and you just show how the calculation is done, and then everybody does it at their own ends. Yeah.
Okay, I will make slowly to make the calculations. Okay.
Thank you, Kathy.
Thank you, Pedro.
Yeah, thanks.
Okay. I will go slowly.
Just before you start, sorry, Pedro, I see Godwin, do you want your question clarified now, or do you think it will be covered in the step-by-step exercise that Pedro is going to do now?
Sorry?
I see you had a question which was please clarify. So do you want to address that now? Or do you think it's going to be covered when Pedro goes through the exercise?
Can you hear me?
Very faintly.
Okay.
Can't hear you, Godwin. It's very faint.
Yeah, if you can hear me at all, it's actually a point that I would like to be addressed at the end of the presentation.
Is it on my side only? Can you hear Godwin? I can hear him very faintly.
Yeah, we don't hear you very well, Godwin.
Yeah.
Can you try your mic to be closer to your mic, or
try again, Godwin?
Or he just posted in the chat in case.
Okay,
yeah.
Thanks, Godwin. Thank you. So it says in all these methods, what are we largely measuring? Tax evasion or avoidance? 2, what are the potential gaps between measurement and enforcement? For instance, an oil multinational corporation charging some of its profits in Nigeria to an insurance and banking subsidiary offshore. What are the chances of a successful regulatory or punitive action against the multinational corporation?
Well, I will try to answer.
Thanks, Luciana. Thank you.
Okay. Well, but the first question, so in all these methods, what are we largely measuring? Tax evasion or avoidance? The answer is, as I presented during the case study, according to our experience, the calculation don't tell you if it is tax evasion or avoidance, or even legal avoidance, you know. So you have, I don't know if you work for a tax administration, but it is important always to have in mind that to affirm, to say, no, this is a tax evasion, or no, this is a transfer pricing issue, you have to conduct a tax audit, you know. And it also depends on the legal framework you have in your country, and depends on the evidence you collect during the audit. And we have also discussed this other sessions with the UNCTAD. It is certainly unfeasible, it's impossible to estimate statistically if the underinvoiced, or that's why we call it potential underinvoiced amount, because it's a kind of abnormal prices analysis. You know, for us, it's a more a risk analysis to you know, if you find an abnormal price, you can audit it and verify if it is a really mispriced transaction, or if as Bojan presented before as well, or if it is a price that is below the lower bound because there is a contract, or there is something else happening, if it is a transfer pricing issue. So the price filter, we use it in Brazil more as a risk analysis tool, you know. So there is a difference, you know, the question to you say, what are the potential gaps between measurement and enforcement? That's exactly what I'm trying to explain, that it depends on the audit case. You have to audit case by case to understand if it is a case of tax evasion or aggressive tax avoidance. And it also depends on the legal framework you have to do any kind of enforcement. Let me see, for instance, insurance and banking subsidiary offshore. Well, I don't know if you want to explain or more, but I think it's really difficult to answer this question regarding the multinational, the oil multinational, because it really depends on the legal framework you have in force and the evidence and details. I don't know if I can answer it. I'm sorry.
Okay, yeah, can you hear me now?
Yes, we can.
Okay, yeah, first of all, let me apologize for that interruption. I was actually typing that question to post in the box for it to be addressed at the end of the exercise. So I'm sorry for the interruption. Yeah, so for the actual, the example I gave, it's actually an actual case reported by Reuters. I think I'll post the link to you, Luciana. You read it and probably you'll be better positioned to address it. Thank you.
Okay. I don't know, Pedro, if you want to continue.
Okay. I will continue to answer the exercise. I will go slowly. Then we have this Excel sheet that we will try to make our price filter range. And this first ABA is our original file of 3 days. And then we ask you to answer some questions to guide through step by step to calculate the price filter method. First item is define the type of each export transaction, taking into account the country of acquisition and the country of destination, if direct or triangular indirect. The first item is here. We will put our answer here. How can I do this? Well, this is a simple formula in Excel. I will compare the country of acquisition and the country of destination. If country of acquisition is equal to country of destination, is a direct transaction. If country of acquisition is different, is a triangular indirect. How can I make this? Is a formula in Excel. I put my click in this cell, equal, and there is a formula. I'm sorry, my Excel is in Portuguese language. Then I will use formulas in Portuguese, but I will translate to English to you that speak in English. But the formula in English is if. But I will put in Portuguese se. If I put parentheses, now I will make the logical test. If I click in country A and test if country A equal country E. This is the test. If country B equal country, if country acquisition equal country destination. I put semicolon. If this condition is true, or if country of acquisition is equal to country of destination, type direct. Semicolon. If country acquisition is different, type triangular indirect. Close parentheses. Here it is. He calculates if country acquisition is equal country destination. In this case, it's different, and the formula put triangular indirect. I will replicate this formula to all of my sheet with double click here in lower right. Okay, let's inspect. Some of the operation are directs. The country is equal. But most of operations, most of the transactions are triangular. Some are directs. Then this is the answer of our first item. We calculate the type of transaction in an Excel file. Let's go to the next step. Next step, calculate the prices US dollar by ton. Let's return to our sheet. Item 2. We will put here. We have here two metrics. Total value of operation in G column and quantity in tons in F column. To calculate the price US dollar by ton, you must divide total value of transaction by quantity. Then I will put here equal equal, click on value by quantity. And we have the price of operation. Again, I double click in lower right and reply, and the formula goes through our sheet. Okay. This is the step 2. We have now the prices of all the transactions of our file. Item 3, detect the outliers. I will click item 3. Then we will detect the outliers in this way. I must first identify the first quartile and the third quartile. Then there is a formula in Excel called quartile that simplify our work. I will then click in lower quartile here, equal, and I type quartile. Is this formula quartile here? I can double click here and open. First of all, he asked me matrix. Matrix is our, we will calculate our entire database, 3 days. Then I select the prices because I need the drop the outlier of the prices. Then I will select all the prices. Okay. Semicolon. And then he asked me which quartile I want. I will choose first quartile. Here is primeiro quartile is Portuguese, but in English is first quartile. I close the parents. And here it is. This is the first quartile. This one. This, we calculate this one now. Now we need the third quartile. This one. To do this is the same thing that I do that I did earlier. Equal. I type quartile. I choose the range of our prices. Semicolon. And now I will choose third quartile, terceiro quartile, third quartile. Close the parents. Here it is. This is the third quartile. Now I must calculate the interquartile range.
Pedro, I'm sorry. Can I just interrupt you a little bit?
Yes.
Can you just double check the first quartile formula you have in there? In the cell, so M3, if you just click on the cell and double check your formula. I think there might be a little bit of a mistake in there.
Here?
No, in the first quartile. This one, yeah. I think this is the minimum value. You should add number 1.
Yes.
Yeah.
Yes.
Okay.
Yeah.
Thanks.
Thank you.
Sure. Thanks.
Thanks, Bojan.
Yeah.
Sure.
Thank you, Bojan. Now I need to calculate the interquartile. This range. Third quartile minus first quartile. Equal third quartile minus first quartile. I have now the interquartile range. Then I need to calculate the lower quartile and the upper to drop our outliers. This red zone is the zone of our outlier. The prices lie here will be dropped of our sheet. And I will calculate the lower quartile equal first quartile minus interquartile range times 1.5. This is a lower quartile, is this point in our sheet. The upper quartile range, upper outlier equal third quartile plus interquartile range times 1.5. This is our upper outlier. Then we have the numbers of this point, and this point. And now I will test my database to select the prices that are below the lower outlier or above the upper outlier. I will make this with a formula. The same formula if that I used earlier. Equal. I use again Portuguese, but in English is if. Okay. Se if my price was lower than this value, 261, type outlier. Else, again, if my price upper than this value, 423.78, type outlier. Else, type nothing. Let's replicate this formula to our database. Let's see. Look that. One outlier here. One here. Let's check. 470 is upper than 423 is outlier, okay. 225 is lower than 260 and is correct. Then detect outlier. Look that there is a very, very high outlier. This is a thing you can find frequently in databases. Noises, some type of wrongs, but for this it's important to do some outlier detection to clean our database and don't commit mistakes. Okay. We detect then our outliers here. Next step, drop the outliers of our database. Then we identify our outliers. We will drop here our outliers. I will copy this column detection here. Copy only values and search our outlier and drop them. This is not necessary to our works. Okay. Now our database don't have outliers and is ready to work. Item 5. Calculate the weighted average price by day. Okay. Look this formula, weighted average. When we use a simple mean, we don't need this formula. We only divide the sum of ton by quantity. But weighted average, we use the sum of quantity versus price divided by quantity, sum of quantity. This is, we will go now. We have price with quantity here equal price versus quantity and quantity here. I will replicate this formula to our database, and now you have 3 days of the calculate quantity and price times quantity. Now I will use a script of Excel that make easier our work. I will mark all the database, and in data here is in Portuguese dados, in English is data, has a formula subtotal. I will choose this formula, and this formula is aggregate formula. For each alteration in date, the formula takes the sum of the price, quantity, price times quantity, and quantity, and shows. I will now, okay, here. And in the left here, we have 3 points of aggregation. I will choose the second point, and we will aggregate the sum of price quantity by day. This is needed to our calculus. I have a sum by day of price quantity and quantity. Is this formula here, sum of price with quantity, numerator, and sum of quantity, denominator. I divided one by other and I have a weighted average price equal price quantity, this by quantity, this. This is our weighted average price. I replicate the formula. I have 3 days, and each day has a weighted average price. Okay, this is one step of the formula. Next step. Insert the weighted average prices in the sheet. Well, we have a weighted average here in item 6. We must insert here our weighted average, taking into account the day of occurrence of transaction. Each day must have a moving average. I will put here to facilitate in yellow our results of last item. I will copy these 3 moving average to here. Right click, special paste, values. Okay, here we have our 3 weighted average prices. Now I must put this here. How can I do this? Maybe manually. I put one by one, but it's not so good. In Excel, have a formula that takes easy our work. The formula is proc v. If I put equal and type PROCV, that is a formula. I will search this date, the first column A, this date, in these 2 columns, the second value. Look this. We have the first M is the date. The second is our weighted average. Then I will search this data in this database and pick up the second item. Close the parents. Look that. The PROC-V search September 1st, here, September 1st, take the second column, 355.24, and put here. I will replicate this formula. Let's see if other days look. September 2 is our average, and September 3 is this.
Pedro, can I make a short intervention, please?
Yes.
So I think so. This proc V, this sounds like a Portuguese formula. I think in English we are looking at the V lookup. I don't know how.
I don't know. I think English is proc V too. No.
I don't know. I don't know what other participants, whether they have it. To me, it sounds like a V lookup. But
yeah, it does look like a V lookup.
Yeah.
On my side. I've not seen proc V.
Yeah, I think so, Bojan. I think it's
okay.
V lookup.
Yeah. Okay. So let me type it in the chat so people. So when you do the V lookup, you should be able to get this. It essentially has the same elements.
Okay.
Of course, it's the same formula. Yeah. Thanks.
Thanks again, Bojan.
Sure.
Then in English is V lookup this formula. In Portuguese is proc V, but the result is the same. Okay. Then we have here our weighted average by day necessary to our formula. Let's go to next step. Calculate the standard deviation of price by day. I think 7. We will use the same thing that you use to calculate the weighted average price, only calculating the standard deviation. Here in our sheet, we have the date and the prices. We need to calculate by day our standard deviation. Then I will make the same thing I did in item 5. Mark all the sheet, data, subtotal. Each alteration in date, I will take the standard deviation of the US by ton. Then the program will aggregate by day calculate the standard deviation. Okay. The same thing that I did in item 5. I will choose item 2 in the left and obtain the standard deviation by day. And they will use in our formula.
Pedro.
Yes.
Faz diferença se tiver que escolher o 2 ou 3 em vez do 2?
Would it make a difference if we chose 2 instead of 3? I wanted to find out if there would be any difference if in these columns that where you produced 1, 2, and 3. Would it make any difference if I chose 1, 2, or 3? Yes, 3 would show the whole thing, but 2 would show per day. I would choose 2, but if I choose 1, it won't show per day.
I was asking Pedro if it makes a difference if I choose 1, 2, or 3. No, because he's always choosing 2. So I was asking him if it's make a difference to choose 1 or 3. So he was explaining that if you choose 1 is the aggregate, if you choose 3 is by day. Now we are seeing Pedro.
Yes. He asked me what's the difference between 3, 2, and 1? Is aggregation level. Aggregation level 3. He show all the sheet. If I choose 2, it show aggregate by day. if one aggregate all the sheet. But I need aggregate by day, then I choose 2. It's okay?
Yeah, okay,
your question?
obrigado.
I need standard deviation by day, then I choose 2 and obtain the standard deviation by day here. Okay. Item 8, insert the standard deviation of price in the sheet. It's the same thing that we made in average price. I have here a space to put the standard deviation. I will copy from here. Values. And I will use the same formula that I used in weighted average. In English, then is V lookup. In Portuguese is proc V. My Excel is in Portuguese. I use Portuguese, but in English, please use V lookup. I choose this database, semicolon, 2. Okay, I will replicate this formula here. And then our standard deviation. Okay, let's go to the next step. 9, statistically estimate the price filter using the weighted average price and set the upper and lower bound prices using the standard deviation. Item 9. Well, now we will calculate the price filter range, lower bound and upper bound. Lower bound is weighted average minus standard deviation. Upper bound is weighted average plus standard deviation. I will do this. Equal lower bound equal weighted average minus standard deviation. Upper bound equal weighted average plus standard deviation. I will replicate this formula, and then we have by day our price filter range. Upper and lower bound. It's a simple formula. I will go to the next step. 10, identify the transaction level invoice price below the lower bound in the period. Let's go. 10. I need identify when the transaction level is below the lower bound. I have lower bound in this column. I have the price in this column. This price is lower than this. I will put here. If not, I will put 0. It's a simple formula. We use it earlier. Is the if equal, again, English if, Portuguese se. If this price is lower than lower bound, semicolon, show this price. If not, show 0. We replicate. Now we have here the transaction level invoice prices that lie below the lower bound. Let's check this. Weston 313 is lower than 333. It's okay formula. Let's check here. 335 is above 333, 0. Okay. Then we show here only the prices that are below the lower bound. Our suspicious prices. Okay. Next one. 11. Calculate the difference between the lower bound prices and transaction level invoice prices below the lower bound in the period and estimate the potential under-invoiced amount or undervalued store transactions, abnormally underpriced transactions in relation to the lower bound prices. I need the difference when this price is 0, the price is not on below the upper bound, I need to put the difference 0 here, because if not, the difference between lower bound and this, you see great, but must be 0 because don't have a suspicion here. Then I need to put a formula here. I will choose a formula if, again, if C, this price upper than 0, I want the difference between lower bound and this price. Else, I need 0 here. Let's replicate the formula. Okay, here, when it's 0, it's 0. And when is below the lower bound is the difference. And now the potential under-invoiced amount. Potential under-invoiced amount is this difference times the quantity of transaction equal this difference times quantity of transaction. Duplicate, and then we have the potential under-invoiced amount of these 3 days of operation. I will calculate here in this cell the total amount of these 3 days. I choose only the sum formula. Mark this column. Okay. This is the potential amount. of the operation. 1 million to about 1.2 million dollars for this commodity in these 3 days of potential underinvoiced amount based on price filter method. This is our price filter method. And now in the next item, calculates the percentage of triangular indirect transaction with low tax jurisdiction, tax haven, or privileged tax regimes. How much of these operations are of privileged tax regimes? Well, here in the O column, we have the type of jurisdiction. In Q column, we put 1 in all the lines. Is the total of transaction. I will sum the total of transaction. 135 transactions. But I need to calculate how much of that are with privileged tax regimes or tax haven. Then I will make a calc here. Again, this. If this column equal privileged tax regimes, but 1 else, else if these columns equal tax havens. But 1 else, but 0. Okay. We have a formula here. When this column is privileged tax regimes, 1, when tax havens 1, or when the other jurisdictions 0. Let's replicate the formula. Other jurisdictions 0. Okay. Now we sum this column. We have 117 tax havens and privileged tax regimes. This represents this by this 86.7% of our operation. Most of operation are with these privileged tax regimes or tax havens. Is from this type of commodity that we are working. And the last question, I think Luciana will answer.
Can address it. Okay, thank you, Pedro. I think this is a very good exercise to understand also the limits of this method. Because in our case, studying the soybean trade market, we saw a very, very high reliance on transactions with these intermediary entities located in low tax jurisdictions. And our conclusion is that if you have a database mainly that shows you that almost all transaction level data is almost all export transactions rely on this kind of structure. Probably the prices, almost all the prices probably are have the prices already affected by these structures. So we would have probably a bias down the database. And of course, the results would be biased down as well. So after we had this conclusion, we started looking for different approaches to build the price filter. So we try to use the UNCTAD database or even the IMF primary commodity prices database. So you can set a higher level of for the price filter. So we believe we're gonna have more transactions detected as suspicious under-invoiced transactions. So we suggest that this kind of analysis before, or during the process of defining which data or how you will set the price filter. I think it is important to say as also, Pedro, if you can show the first item in the file, if you can zoom the images. Maybe you're not used to this kind of data, but you can find this data in transaction level trade data collected by customs. You always have the country of sale or the country of acquisition. And these are the jurisdictions that are reported as the importer or the exporter. So the country of sale is always the exporter, and the country of acquisition is always the importer in an import or export transaction. And you're gonna have also the country of destination or the country of origin of the goods. So it's important to notice that the country of sale or acquisition is not always the same as the country of origin and the country of destination. And this kind of intermediate structure we found is used both in export transactions or import transactions. And it is important to analyze if you have a very high reliance on this kind of structure when the intermediate country or the country of acquisition is a low tax jurisdiction, because it might reveal tax minimizing rules, and probably the database would be affected by this kind of structure. So it is important to test a different approach to set or to build the price filter. I don't know if Bojan has something to add or a comment regarding this definition of the price filter.
Hi. No, actually, I think, Luciana and Pedro, I think this was a very, very detailed, very, very thorough and comprehensive, presentation and approach. So I think even earlier in your discussions or your responses, I could just echo whatever you have said. So it shows clearly how important it is to have a good collaboration among units, to identify data sources, to bring experts on board to try and provide interpretation, both at the input but also at the output, so at the results phases. And I think what you also put in the chat as a brief response to the question, I think it was Godwin's, about the administrative and statistical purposes. We have addressed this question a few times in the last week, and this, of course, goes the same here. I think this is a brilliant. So Luciana was responding earlier. Police records and those suspicions. So this is clearly a nice indication of how the administrative purpose or administrative data sources could fit into the statistical work and the statistical purpose of the measurement. So no, I don't have anything specific to add, except that I think it is a much clearer picture of what and how the price filter method could be applied. Of course, it shows that there is a tremendous amount of input required. So not only in terms of data, but also in terms of understanding the data, cleaning the data, and making them useful for the application itself. Specifically, also referring to the price filter determination. In your earlier responses, you said, yeah, so it could be either a one standard deviation, it could be interquartile range, it could be something different depending on the commodity that is being treated. Yeah, so much from my end. Thanks.
Okay,
thanks so much, Bojan.
You.
And Luciana and Pedro, that was excellent. Thank you so much for the very sort of patient and painstaking ability to actually sort of walk us through the process, like step by step. But I think you're a saint. I certainly don't have your patience to do that. But it was really excellent, and I'm sure everybody that has participated has really enjoyed the way you've actually walked us through the entire process and how this methodology actually works in a great level of detail. So I think we're very grateful. From my side, Bojan, I think that's it. Do you want to do any closing remarks as we close off the final session?
Well, I just have to extend a very big thank you to all the participants for their active role today and throughout previous days, to all of our how should I say, moderators and facilitators, extending their knowledge, sharing their expertise, to providing a better support so we can then move ahead with the applications. Of course, it goes also here whenever any of particular countries or technical working groups in a country would be taking steps to apply a specific method, new questions, more concrete questions will pop up. And of course, we are here to support this. So please do not hesitate to get back in touch with us with all the specific questions you might have, and we will do our best to, bring in and pool all the expertise to provide a best guidance possible to address this. Last but not least, of course, a big thank you to all our interpreters. I think simultaneous interpretation of this wonderful topic is a challenge in itself. So thank you. And of course, thank you also to ECA and UNCTAD colleagues, both the IT part and everything else to make this whole sessions running smoothly. We have tried our best, given the technology, to record all these trainings in different languages. We will see what has come out of it, and whatever is usable, we will put them online. So please do visit this website. It'll be updated with the links and with new additions of translated documents as they become available. So we will be posting them online. So having said this, again, a big thank you to Pedro and Luciana for today. I know it was very early in the morning for you, so super much appreciated. Yes, and with this, I just wish everybody, please stay healthy and good luck with all the work. Thank you.
Thanks so much, Bojan. And with that, I'm actually going to close off the event at 2 o'clock precisely. So thank you very much. And for those of you taking some time off, please enjoy the holidays. And yeah, we'll see you on most of you in the new year. Take care and stay safe.
Thank you, everyone. Merci tout le monde.
Thank you.
Thanks a
Bye-bye.
lot,
Thanks,
Kathy.
Valentin.
Thanks, Bojan. Thanks,
Thank you,
Luciana.
Katerina, for everything as well.
Thanks, everyone. See you soon.